Hi guys, it's Stock Curry, and the expectations for Friday CPI inflation numbers just got worse. In today's video, I'm going to explain how that's going to affect your stocks and how it's going to change the Fed's plan to fight inflation. So let's get into it! Before I get into the new CPI expectations, I first want to give a quick recap about how inflation is affecting the economy. Inflation is causing consumers to spend less and change their shopping habits. Now, this might be good for some companies. For example, more than half of those surveyed said that the rising meat prices made them curious about trying plant-based food products, such as those from Tattooed Chef and Beyond Meat. So some companies might benefit from this, but the vast majority are getting hurt because Americans are doing things like taking fewer trips to the grocery store, spending on generic brands, just trying to save money, eating out less and eating at home more, and even buying in bulk. And of course, this isn't just affecting grocery store spending, this is affecting spending across the board. We've already seen companies such as Amazon, Apple, Target, Walmart, all of them reporting reduced spending from consumers, and as a result, they've been all forced to reduce their guidance for the year because consumers just aren't spending as much money. This hasn't just caused companies to report weak forward guidance, it has also resulted in a number of layoffs from some pretty big companies. And the latest round of layoffs comes from Stitch Fix, who is announcing a 15% layoff of their total number of salaried workers, or about 330 people. Shares of Stitch Fix are now down to $7.78 from a high of $68. The stock is down 85% from highs. And of course, as inflation rages on and consumers spend less and companies do more and more layoffs, things are going to get worse. Not better, worse. Gasoline prices aren't helping either. Gasoline is approaching $5 a gallon, which economists say is the price point at which a recession would be caused just from gasoline prices alone. The problem with this high inflation and high prices is that consumers have less and less money to spend, meaning they're not able to go out and spend money at all these different companies. So that's already causing earnings to go down. It's already causing companies to do these layoffs. And all of this combined, the high prices, the layoffs, the lower earnings, all of it will eventually lead to a recession. And a survey of chief financial officers shows that most CFOs believe the recession will start in the first half of 2023, with the Dow dropping into bear market territory, or about another 9 to 10% from its current price. So with all of these things happening and inflation leading us into a recession, it's very, very important that the Fed raises interest rates in order to get inflation under control. Because if the Fed is unable to get inflation under control, that is going to cause either hyperinflation, meaning the prices get so high we end up in a situation like Venezuela or Zimbabwe or many of the other countries that dealt with hyperinflation, and that's certainly not a good thing. So the Fed's alternate is to just raise interest rates no matter how bad the economy gets, and that in turn puts us into a really bad recession. So literally the Fed's options are do nothing, allow interest rates to go up, and that causes a recession, or raise interest rates in order to get inflation under control, and that causes a recession. The Fed's only two options are recession or recession. In one hand, if the recession is caused by hyperinflation, then the Fed has no control over the economy. But if the Fed can cause the recession themselves by raising interest rates, then at least the Fed has control over the recession and they can lower interest rates in order to get us out of a recession. So that's the point at which the Fed is going to go. The question is, how quickly are they going to raise interest rates? Now, currently, the stock market is pricing in a certain number of interest rates. Specifically, the stock market is pricing in a 50 basis point rate hike, or 0.5% rate hike, for the next two meetings, and then 25 basis point rate hikes, or 0.25% rate hikes, for the remainder meetings for the rest of the year. Now, if inflation is super high, if the current rate hikes the Fed is doing is not getting inflation down, then the Fed is going to have to raise interest rates a lot faster than expected. And those higher interest rates are going to cause a recession to start sooner, and it's also going to cause a recession to be more severe. So we absolutely need to see inflation going down in the CPI. Now, the CPI is the Consumer Price Index, and it's a measure of inflation. And now, in March, the CPI topped out. It hit its highest level in over 40 years. In April, the CPI came down a little bit, down to 8.3%. That means inflation rose 8.3% year over year in April. Now, May's inflation numbers that come out on Friday, June 10th, which is tomorrow or today, depending upon when you're watching this video, those numbers need to come in lower than 8.3%. Because if they do, that means that inflation is going down, and it's a really good sign that the Fed is getting inflation under control and that they can just continue to go on the rate increase plan that they're currently on, which means the stock market is going to breathe a huge sigh of relief and will probably be able to go up for a week or two. However, if those inflation numbers come in the same or higher than where they were in April, that means inflation is not going down, and it means the Fed will most likely have to raise interest rates much faster than expected in order to get inflation under control. Now, if that is the case, that is going to cause the stock market to crash hard and fast starting on Friday. And I know the stock market's already down a lot. Believe me, it's about to go down a whole lot more if inflation doesn't start getting under control. Now, with the CPI inflation numbers coming out on Friday and me recording this video on Thursday, we don't know what those numbers are yet. So let me show you what analysts are expecting for the numbers. Before I get into this, I just want to let you know that up until today, analysts were expecting an 8.1% increase, meaning we have an 8.1% year-over-year increase May over May, which would be a decline from the 8.3% in April. But now, economists are expecting the CPI number to come in at 8.3%, which is the same as April. When that news came out today, the stock market absolutely tanked. The stock market was trading flat all day, doing great, and then all of a sudden, the expectations for the CPI were raised from 8.1% to 8.3%. The stock market panicked and sold off over 2% during the day. And this is just a little preview of what could happen if the inflation numbers on Friday come in at 8.3% or higher. 8.3, 8.4, 8.5, any of that is going to cause the stock market to go down on Friday and probably continue down for another week or two. So today, Thursday, was just a preview of what's going to happen if these inflation numbers don't go down over where they were in April. And in case you're wondering, the CPI, or Consumer Price Index, comes out at 8:30 a.m. Eastern Time on Friday, or about 1 hour before the markets open. So that's what to expect for Friday when the CPI inflation numbers come out. Just keep in mind, and I don't know why this is the case, I've just seen it happen over and over and over again. For some reason, when the numbers come out pre-market, that first hour from 8:30 to 9:30 in the pre-market before the markets actually open, sometimes the market reacts to the complete opposite of how it ends up reacting throughout the day. So, for example, the market might go down 1% pre-market, and then throughout the day, it rises and we close up 2%. Or the exact opposite. Pre-market, it goes up 1%, and then throughout the day, we sell off and we close down 2%. So don't trust the pre-market numbers necessarily, because the market may not finish in the same way that it starts in the pre-market. So just keep that in mind. Really what you want to look at is the actual number. Is it higher or lower than 8.3%? If it's higher, you can expect the market to go down. If it's lower, you can expect the market to go up. Also, I wanted to let you know that I have a lot of trades planned for tomorrow depending upon which way the market moves. So if you want to know what I'm buying and selling Friday and you want to get into my trades and make money with us, come join us over the VIP Discord. You can sign up for that, get all my trade alerts at stockcurry.vip/getvip. That's stockcurry.vip/getvip. And I will keep you informed and up to date on exactly what I'm buying and selling in order to take advantage of Friday's volatility. Also, I wanted to remind you to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you on Monday.